The economic landscape in the United States has been characterized by anticipation and pivots in expectations regarding interest rate cuts by the Federal Reserve. President Joe Biden, along with investors and homebuyers, initially held optimistic views about potential rate cuts, expecting them to stimulate economic growth. However, recent developments have introduced complexities that challenge these initial expectations. In March 2024, U.S. annual consumer price inflation reached 3.5%, surpassing expectations for the third consecutive month. This surge in inflationary pressures coincided with a notable 0.7% growth in retail sales, signaling robust economic activity. Investor sentiments initially reflected optimism, with expectations of significant interest rate cuts to address inflationary concerns. However, these sentiments have since changed, leading to a shift in market pricing. Market participants, who had previously priced in more than 1.5 percentage points of interest rate cuts for the year, now anticipate a more conservative reduction of only 0.5 points. The Federal Reserve finds itself at a crossroads, grappling with the dilemma of whether to proceed with interest rate cuts amidst a backdrop of robust economic growth but persistent inflationary pressures. Chairman Jerome Powell has advocated for a data-dependent approach, emphasizing the need for caution in adjusting monetary policy. This cautious stance reflects the Fed's acknowledgement of the delicate balance required to support economic expansion while addressing inflationary risks. The implications of tighter monetary policy extend beyond immediate market reactions. A shift towards higher interest rates can impact various sectors of the economy, including corporate debt, mortgage rates, and government debt servicing. The International Monetary Fund, IMF, has revised its growth forecast for the U.S. economy, projecting a 2.7% growth in 2024, up from the earlier expectation of 2.1% in January. However, this resilience to higher rates is not without vulnerabilities, as prolonged exposure to elevated rates could strain corporate finances and government budgets. The impact of high interest rates in America extends beyond its borders, influencing global economic dynamics. One significant effect is the strengthening of the dollar, which has risen approximately 5% against major currencies. This appreciation can have dual consequences. While it makes exports more competitive, it also disrupts trade and borrowing denominated in dollars, particularly affecting economies reliant on commodity imports like Japan. This dual squeeze from a stronger dollar and rising oil prices poses challenges for these economies as they navigate the implications of U.S. monetary policy on their own economic landscapes. The Federal Reserve's stance on interest rates has triggered notable shifts in financial markets and investor behavior. Initially, the Fed's dovishness in December led to a stock market boom, with the S&P 500 index surging by a fifth. However, recent corrections in stock prices reflect a recalibration of investor expectations in response to changing rate cut projections. Investors have adjusted their strategies accordingly, moving from anticipating multiple rate cuts to now expecting a more modest reduction of 0.5 points. Higher interest rates pose risks to the banking system, particularly regarding unrealized losses on banks' balance sheets. As bond yields rise, the value of government and mortgage-backed bonds diminishes, leading to potential losses for financial institutions. This vulnerability underscores the importance of monitoring bond yields and overall financial stability in the context of tighter monetary policy. Additionally, higher rates can impact bond yields directly, influencing borrowing costs and investment decisions in the financial sector. Looking ahead, potential future scenarios include the possibility of rate cuts if high rates begin to impede economic growth. While the current stance prioritizes addressing inflationary pressures, a balanced approach to monetary policy is essential to maintain economic stability. This entails navigating the delicate balance between supporting economic expansion and managing inflationary risks effectively. The Federal Reserve's upcoming projections in June will provide further insights into the policy outlook and potential adjustments based on evolving economic conditions.